If you want to take a company public, a couple of things have to be true. One, you've got to be large enough that the marketplace will appreciate you, and that the number of shares that you will have in the hands of the public are sufficient to have enough trading volume that there's a stable price on your company. And what that means is you not only have to take your company public, but then you have to have in the aftermarket afterwards companies that make a market in your stock. In other words, they buy stock off the market and they hold it in an inventory. And then when the demand for the stock is high, they sell into the demand. And when the demand for the stock is low, they buy into the lack of demand, okay, stabilizing your stock price. They make money doing that, but they have to have an interest in your company. So your company needs a good story. It needs something that tells the marketplace your company is worth investing in because it's going to grow. So the first thing that you've got to do is understand that you've got to have a strategy for taking your company public. It's not just that you get to a certain size and you can do it. It's got to be, how are you going to excite the public about being an owner of your shares? So when we take a company public, the first thing we do is we literally hire, okay, a PR person whose job, and it's a financial PR person. It's not just an ordinary PR person. And that person's job is to understand the marketplace and to make our company attractive to where the public wants to own it. We then make deals with aftermarket market makers to make sure that there's an inventory of the stock that stabilizes the stock. And then the next thing we do is we work with what's called an investment banker, who will actually undertake the sale of the stock to their clients and maybe even syndicate it with other stock brokerage firms to market the stock to their clients. And so you have a number of parties that you pull together. And those parties are your investment banker to back the underwriting. And by the way, there's two types. There's what's called the best efforts offering, which means the investment banker doesn't guarantee you anything. They're just going to sell it. What sells, and what doesn't sell. Or you have what's called a firm commitment, in which case they're going to guarantee that if the stock doesn't fully sell, they'll buy it and over time work it into the marketplace. You don't want to go out for a best efforts, okay? And the reason for that is you may end up with this big amount of unsold stock. You didn't raise the cash that you had planned to, and now you got this thin float because there's not a lot of stock in the marketplace, so your stock price is not going to be very stable. So these are the big elements that go into this, and you don't go into it unless you got a hot product for a company. So if I were going to take a company public today, I would either want to have one of several things to be true about it. One, I'd want it in a technology that's hot. Everybody wants to buy artificial intelligence companies right now. If I had an artificial intelligence type company, I'd be looking to take that public at some point in the process. And I would get investors today who would come into that company, probably brought in by my investment banking firm, because they knew that investment banking firm was going to take this company public, and what they're buying that stock in the company for while it's private is a fraction of what it's going to be valued at once it goes public. So that's one of the areas. If I have a high-tech company, but let's say you have a low-tech company, there are lots of strategies that can make a low-tech company worth a whole lot of money. Okay, one of them is a roll-up. Okay, what's a roll-up? You go up and you buy up your smaller competitors, and you use the economies of scale of now a bigger company that can buy better than the little subsidiary that you now just bought, or it has, you bring it into your management systems, which now can take a company that was a little chaotic because it was small and not well managed, and now it brings it under your umbrella and it's well managed. So there are strategies that you can take a low-tech company and project a fairly substantial growth rate for it, which will get investors excited, and you have the opportunity to become a public company. So again, without getting into every structure or every strategy for doing this, the main thing is that you've got to have a growth strategy for your company that the public can get excited about, or you shouldn't think about going public. Now, a lot of companies that have gone public only find that it's only a few years and they go private again. They buy back their stock from the public, because when you do go public, you have another layer of regulation, you have another layer of administration, you have costs that you don't have as a private company. And unless you're raising a lot of money and you have growth potential, you don't go public, because it is, in the end, you're going to find it is more troublesome than it's worth. But if you have good growth and you have a strategy for great growth and you have an opportunity to go public, then orchestrating all the elements that I just mentioned earlier are well worth it. But it is sophisticated enough of a process that if you're going to do it, you want somebody on your team who has done this before. Somebody who knows what all these elements are, how to pull them together and make them work, how to cover the costs of getting to the public offering, and then how to actually structure it so that the company ends up with a lot of cash and a lot of shareholders that are making a great market in that stock afterwards. And the advantage to you of that, by the way, if you're in the building your business through acquisition, is before you go public, you have to buy your companies with some form of cash. Once you go public, you can buy them with your stock, which means that now when you want to acquire a company, instead of having to go out and get cash for the acquisition, you can run the printing press that you now have and you print stock that you now issue to them, which has a market value. Okay, so they know the value of what they're getting. Now, if you have what's called a large float, a lot of shareholders own your stock, you got great market makers stabilizing your market. Okay, then as you print that additional stock, your market actually has the opportunity to go up, because your PR people are going to get the marketplace excited about your growth that you're just incurring through your new acquisition. So the price of the stock is going to go up. The people that you've given stock to buy their company get excited because they get it at a certain price. And now the price is going up because the marketplace is excited about your acquisition. See, it all has to get orchestrated together. You need somebody on your team who understands these elements.